Hello, I've been given the go ahead to start. So let me just start off. So today's, I think we got a comment also. Today is the Investor Day, and we've had two very, very good webinars before this. One is on financial planning, and the other one again was to do with a lot of corporate India stuff. But this is a very simple presentation, simple webinar. Uh, Usually, I keep all the webinars very interactive, so we can have a very good dialogue at the end of this. You will have polls coming in the middle, and we can have a good Q&A session maybe after 20-25 minutes once I'm done with the presentation. I always like to keep things very simple, so this is also kept very simple. And the idea of Milestones to Wealth has always been more from a behavior perspective, and to help investors reach their target of 1 crore, right? So today's program is also sipping your way to a crore. We understand that everybody is aspirational. All Indians are now very, very aspirational when it comes to meeting their goals and the goals that they want to achieve. And 1 crore is the best way for any investor starting off to put a pin on saying, yes, I want to achieve that 1 crore. And what does it take for me to achieve that 1 crore? Right? And SIP in India is the best way for investors to build that habit of being consistent. Right? If you want to reach that 1 crore, you have to be very, very consistent. Right? And consistency is the most important metric to how you can judge your behavior. You can gauge your behavior in such a way where you can slowly start building up to a particular milestone, right? You put a particular milestone, say 50 lakhs, and you achieve that 50 lakhs and then 50 to 1 crore, right? And in India, SIP is the best way for anybody to start saving and using mutual funds as a savings vehicle to achieve that 1 crore target, right? So this is one slide with which I always start off most webinars and presentations with, is understanding market cycles. And this is the most important slide when it comes to being a saver in India, where you have to understand that everything is cyclical in nature, right? And how do cycles work? It's not up down in a day or not up down in a month. It's over long periods of time. It's 5 year plus, where cycles work differently within it. It's different within each asset class. It's different within each category, right? And usually what happens within these cycles is you will have very, very bad times where everybody is very scared to start saving money and investing in financial assets. And then you have other parts where things are looking extremely good, things are looking extremely optimistic, and everybody is just pushing in to save money. Everybody is plowing in into one particular direction and one particular asset class, right? These are how cycles work, and these are all signs of how cycles are working. So today, for example, if you see, equity is the most talked about subject wherever you go. Today, mutual fund AUM is 53 lakh crore, right? And your SIP is somewhere around 90,000 odd crores, right? This has grown tremendously over the last 3 years. You're seeing a lot of investors. You've seen a lot of people come in the last 2.5 years. They are all new investors, and this is where the cycle starts, right? You're seeing high optimism starting to come in, and you're seeing over optimism coming in on one particular asset class, right? Flip on debt. After debt taxations, after the new rule for debt taxation coming in, investors have become very averse to investing on the debt side. So here you have extreme fear, extreme pessimism on one side, meaning nobody wants to touch it. People are extremely bearish about it. And on one side, people are extremely bullish about it. So what do people do usually? Usually people crowd in into the most optimistic asset class, into the most optimistic idea, into the most optimistic company, stock, be it whatever. Optimism is the same everywhere. And then comes pessimism. Pessimism again is the same everywhere, same asset class, same category. But from a behavior perspective, you see a lot of people becoming a lot more positive and negative, right? This induces people to chase trends. And when you chase trends, usually you do not have a very good outcome. Right? I had done this in one of the presentations where we were looking at asset allocation, and 90% of all decisions have to be based only on asset allocation and nothing has to do with market timing. It's only asset allocation that investors need to decide on, and not timing the market or timing or stock selection or mutual fund selection for that particular matter. Right? So market cycles always work for long term, and in every cycle you will see greed coming in where there's over optimism, and fear coming in when there's pessimism, right? And that's when people tell you sell, 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 and then that's when people tell you buy, buy, buy. But Milestones2Wealth works completely differently. It's a behavior program where we help investors with the right set of behaviors in periods of over optimism and in periods of over pessimism. Right. So when the fear comes, that's when you have to scale up your entire savings into that particular category, into that particular asset class. And when greed does come in, then obviously you will be able to reap the benefit. So what do you do during the fear parts and what do you do during the optimistic parts? That's what we are trying to look at. Right. And to neutralize this entire effect and being too emotional during the entire cycle is why we have SIPs, right? This is the individual investor's life stages, right? When you're 22 and you're young and independent, there you have a lot of savings and some consumption, right? But your actual cycle starts only when you're uh, young and married. This is after 27 is where your savings go up, your earnings start going up. Naturally, you start consuming more, right? But 30 to 40 is the best stage for you to start saving for your retirement. You have a long way, right? It's almost 10 to 13 years, right? 10 to 13 years is a very, very good period for investors who have that horizon of retiring after 40. And that's when you have to build your entire corpus, right? And after that, whatever you're able to build for the next 10 years is extremely good, right? So you have a lot of savings while you're 40 and you consume also more. Your savings go up and your consumption goes up, which is basically your earnings. And by the time you're 60, you're up for retirement. So investors in India who are between 40 and 60 have a good 20 years where they can make their money work for them. At the same time, if you're starting early, if you're starting at 30, just add another 10 years or 15 years to that. And that's why you're starting. So you have enough cycles to take advantage of every single time. And every cycle is going to be different. There are different winners and there are different losers in every cycle. Like for example, gold as an asset class was not a winner between 2013, 14, 15. And since 2018, gold has been the winner. Right. So maybe at the end of the presentation, I can take out that chart to show you. It's from another webinar, but I can take that and show you also of how different asset classes win different time and how market cycles over a long period of time look from a broader horizon. Right, but this is your life cycle of an investor. 30 to 40 is where your earnings grow, is where your consumption is growing. And while you build that habit of saving, it leads into you creating an investing habit. And that's what Milestones2Wealth helps you do. It helps you create an savings habit for you, for it to lead into an investing habit. Okay. So let's take a poll. How much of SIP are you currently doing? Is it less than 10,000? Is it 10,000 to 25, 25 to 50, 50 to 75, or is it more than 75? Let's take a poll. You can put in your answers in the chat box. You can put in your answers in the chat box. B. Okay, good. E. Okay, that's good. I'll let the answers keep flowing. No, it cannot be HTP from liquid to equity. Don't consider that as SIP. Consider that as a lump sum that you are trying to time the market by doing something. That's it. Okay, we're getting mixed answers between A and B. A majority of you said between A and B, and the rest have come in the C category. Very less have come in the E category. But anywhere between 10,000 and 50,000 is where investors are lying. But there are a lot of you that are doing less than 10,000. So we'll get to that math as to how somebody doing 10,000 or 30,000 or 40,000, even 75,000 can get to a crore. It can get to a crore. And this has nothing to do with returns. This has everything to do with your own behavior and how you manage your savings well for you to start contributing more to your corpus. This has nothing to do with returns. But your returns are a factor of how you behave and what your behavior actually is. Right? So let's look at this. Right? Let's say if you're doing, since majority you have said somewhere between 10 and 25, I'll take 15,000. Right? How does compounding really work? Let's say if you just grow at a 12% rate, per annum, which compounded, you might not get 12% every year, but compounded, if you see over a long period of time, 5, 6 years or 10 years, naturally you will uh, uh, make that very moderate, good estimate of 12%, right? In India, if you're willing to save, then you should assume somewhere between 9 and 12% as your return assumption in equity, right? So if you're doing a 2,000 rupee or of 10,000 or 15,000 rupee SIP, at the end of the 10th year, that money has gone 2x at around 35 lakhs, right? Next 10 years, you are at 4 times, right? Which means you are already at 1.5 crore, right? So somewhere between, this is just assuming that you're just contributing. You are not doing anything different. You're just being consistent in one aspect of saving money, right? Which is contributing a fixed sum on a monthly basis, right? To your savings corpus, and that continuously keeps on going on for years together. Right. So at the 10th year, it's a 2x. At the 20th year, it's a 4x. Since a lot of investors today don't want to see very minimal returns of 9 to 12% or 12 to 15% compounded, they like to see a multi-bagger come in it. So when do you multi-bag? When you're doing an SIP, you multi-bag right after 10 years, and that is a very reasonable assumption for you and a reasonable expectation for you to do. Where in 10 years you've seen 2 cycles come in, and in those 2 cycles you're able to double. And in the next consecutive cycle, again your wealth keeps compounding and growing, right? This is assuming that you don't do anything. It's just a consistent monthly contribution, a fixed consistent monthly contribution that has to go from your side. And all this is publicly available data. These are all from mutual fund houses. These are all from their own presentations that give you, but it does not get looked at because investors are very obsessed with just looking at direct stocks and not looking at the basket, where they do a fantastic job of giving out data, where they do a fantastic job of managing money at a very, very low cost. Right? So now let's look at one other aspect of behavior, one where you're consistent and the other where you try to increase your contribution that you're able to do on a monthly basis every year. So when did you last step up your SIP? Was it last year? Was it 2 years back? Was it 3 years? Was it 4 years? Or was it never? You did not do it only till now. Never, just started the SIP. Appreciate the honesty. Thank you so much. And there's no question here, but a lot of you have told last year. And if you can just put out your reason as to why did you choose to do it last year? Okay, income went up, salary increase. Okay, which means your base was increasing. Very good. Income went up. Okay, fantastic. Salary increase, very good. See, you're already following the right behavior, right? Where your income goes up, your willingness to save is starting to go up, right? You don't want to do a lot of consumption. You're very serious on how you want to save your money that you're earning, and that's how you're choosing to do a step up. Now, let's look at the math. Since a lot of you have done in the last year, when is that actually starting to when is that actually okay, you're trying to time the market also, okay? So when does that actually start working for you? When does your step up actually start working for you, and how long will it take for you as you keep stepping up for you to meet your particular goal, right? Now let's say if your yearly step up is 25%, which is quite a large step up, by the way. If you're just doing a 10,500 sort of 10,000 sort of SIP, and you step it up yearly by 25%, uh, what is your actual value that starts coming in, right? You saw an area in which after the 20th year is where you start making money. Here, while you do your step ups, you're cut back on 5 years, and you're able to, it's more than 5 years actually. But if you see, if you compare 1.6 to 1.6 there, 1.6 crore, you reach that 1.6 crore only after 20 years of you being consistent in your monthly contributions. And if you step it up, you cut back 5 years and are able to reach the same 1.6 crore target in 15 years, which is 5 years back. Right? You're doing it 5 years in advance. Right? This is the power of incremental investing. Right? This is the power of your step up. As your income starts going up, as you start getting more bonuses, you are obviously looking at other asset. I mean, you are looking at other savings vehicle for you to start putting in that incremental money. And in India right now, equity is the best asset class for you to make more than FD and make more than GDP growth plus your inflation. Right. So naturally, the effect of incremental investing is very large. You're able to advance your goal by 5 years. Right. This is assuming 25% of your total contribution yearly. Right. Now let's look at a very moderate assumption where we just take a 10% sort of annual increase in your SIP, right? If you just take a 10%, that same 10%, that same 10,000 rupees for you is just, you're just having another 10 or say 15-month delay that's coming to you, right? Which means in 15 years, you're able to reach that 1 crore, right? And if as you start doing a lot more, let's say if you're doing 30,000, you're able to meet that in 10 years. So as your income starts to grow up, your contribution starts growing. At the same time, with compounding taking place, you're able to meet that 1 crore target a lot more faster than when you started. Right? So there's 1 crore for you. If you look at the math, 30,000 you're able to reach with just a 10% annual, just a small 10% annual increase is 10 years. Right? As you start increasing it, for somebody who said it's 75,000, this is from your monthly contribution part where you increase it by 10%. It's somewhere around 6 years, right? So in that 6 years, you're seeing a cycle. In that 10 years, you're seeing more than one cycle. And that's how SIPs are starting to work. And people are becoming a lot more aware in terms of the power of incremental investing, right? It's just a small portion of what you can save, but for investors to be able to save that on a monthly contribution, let's say, see, for example, when you're doing 10,000 and you increase it by 10%, it's 1,000, right? Where you are able to contribute, say, 1,20,000 a year, there you're contributing somewhere, by another, by another 12,000. For some people, it's very, very difficult for you to do that because you have to change a lot of your habits. While you change a lot of your habits, which means you have to spend lesser, right? That doesn't mean that you have to consistently keep spending lesser. No, you have a life to live with, but whatever changes that you're able to do in your consumption patterns will help you out. One less Swiggy order or one less Zomato order is actually helping you meet your goals a lot more faster, right? Everybody in India, everybody is wanting to consume a lot more. And as things develop and evolve, you will be wanting to consume a lot more, right? But control that urge for some time. That doesn't mean that you should not indulge in that, but make sure that you're doing it well within range, you're well within control and not overshooting your particular target. Right? So let's look at 5 ingredients to cook the best dip. Somebody commented saying markets had dipped, so I was able to do that. Right. So I think one point would be that where don't stop your SIP, never stop your SIP when the market falls. Don't stop, don't fall into any rumors. Be consistent in what you're doing. Virat Kohli would not have become Virat Kohli had he not been consistent. He had really bad years, and that was his real test. He was consistent, and till today, India Pakistan is still very fresh in my mind. Even the World Cup loss is still very fresh in my mind. But discipline and consistency is what matters when it comes to investing, particularly in SIP. Manage your behavior very well. So don't think a slow start is a bad start. Slow start is a good start, right? Early years of SIP is a real test of your discipline. Right? For first 3 years of you investing, you might not see very high returns that are coming in because you're new to the market. You're only seeing volatility taking place in the first 3 years. So you might see a lot of ups, downs. So don't be scared about seeing such volatility. In the first 3 years, go with that assumption that yes, volatility will be there. Anyway, you have more than a 10-year plus horizon. You don't need to think of the first 3 years. You have to only think of being consistent and showing discipline. Right? Initial years of SIP is when your averaging takes place, because as earnings start to grow up, your markets do get repriced. But even if that doesn't happen, you're still able to average at very bad phases consistently. Right. So all your lows will actually be able to help you out when the highs do come in. Right. So slow start is a good start. Right. Grow your contributions to grow your corpus. Like I said, when beyond a particular size, your initial SIP, right, does not have significant influence on the outcome, right? But as your corpus keeps growing, you need to start contributing more as and when your income grows, as and when markets become a lot more conducive for you to start pumping in more money, right? You must step up your SIP whenever, and this is great behavior for investors who have come onto this program, who have come onto this webinar, where as your income is growing, you have that intention that yes, I want to commit more, I want to save more, and you are willing to save a lot more. Right? Though you do it for reasons saying, okay, the past returns have been great. Even if you do not see past returns, you should be willing to step up your contributions a lot more than the initial SIP that you did, because your initial size, as your portfolio starts growing, your initial corpus might not be very significant in influencing the outcome. Right. So step up is very, very important for you after you've had a very good start. Okay. SIPs recover faster from a bear market. I think there was a very good comment that came in saying, yes, when the markets did fall, I did increase my contribution. So if you look at your 2020 market crash, if your SIP had started in Jan 2018, to recover from that crash would have only taken you 6 months, whereas the index took about a year or so to recover from that particular fall. Right. Same case for the 2008 market crash. Your SIP did far more better. So it's giving you stable returns. It's giving you consistency. It's making you become consistent as an investor. And also it's falling lesser than the market, also able to recover faster from a bad market, which is a bear market. Right. So it's taking you 18 months to recover from a bad market crash. At the same time, you are able to weather through it very, very comfortably without losing a lot of your wealth that you've created. Right. So as you start becoming consistent, as your corpus starts growing, not only you're able to contribute more as your income grows, but you are very well protected in bad times. Right. You are not taking much risk because you're not buying a particular stock. You're buying the entire basket, and basket always helps you weather through bad phases very, very fast and without much scratches. You will get scratched for sure, but without much scratches. Right. So this is the third thing. SIPs recover faster from a bear market than you just sticking to the index or just sticking to a lump sum investing, because there's no averaging that takes place. You don't buy more when the chips are down, nor do you nor do you increase your contribution when the chips are down. Right. Holding it. You have a 20-year horizon, I don't think you should be thinking of selling it at all. Right. Make sure you spend, unless and until you have a goal to meet, unless and until your goals are coming up where you have to meet those particular goals. Right. So if you look at this in 7 years, you are having, let's say if you're doing a 20,000 and your duration is 21 years, we just take a moderate assumption of 11 years. The final 7 years derives almost 70% of the gains made in that entire 21-year investing tenure, right? The last 7 years is what matters, but that is the outcome. The initial plan that you started off doing with, that's your behavior coming into your play. And this 7 years can reduce as your behavior starts improving as an investor, right? So make sure to spend more time in the market with your investments. Don't try to stop. Don't try to shift from here to there. Let it grow and let it grow for a long period of time. All you have to do is try to improve your behavior, try to step up your contributions, and see your gains being made at the final leg of your tenure. Right. Let's say if you have a goal that's coming up in 5 years, then your strategy should be completely different. That we will be able to help you out in meeting those particular goals, right? Because the strategy has to be different. The way you think about that particular goal needs to be different and has to be based on your risk profile, right? So always think of holding it to the last mile, because your initial days of you putting in the work and managing your behavior is going to derive that particular outcome. So if you see here in the math, last 7 years is where you are able to derive 70% of the entire gains in the entire of 21 years, right? Now, every installment counts. The purpose of SIP is to target towards better opportunities. This is what I was telling you about how you shouldn't stop your SIPs in periods of over optimism. You should redirect it towards other ideas, towards other asset classes, because even in a rising market, there will always be opportunities to invest in. Right? Market cycles keep working. Market cycles will always work in one particular asset class in one manner and other asset class in the other manner. Right? So never think of stopping your SIP. Always think about redirecting that particular contribution that you're making into another idea, into another asset class, where your wealth can continuously keep growing. Right. So target your SIPs towards better opportunities. Always have that mentality that whatever I'm putting, every installment here is counting. And if it's going into an avenue where it's overvalued, where the expectations are already priced in very high, I am not feeling very confident of doing in this particular asset class. Please target it towards better opportunities, target it towards debt, target it towards precious metals, and let your contributions keep growing. Right? Don't be stuck to one particular asset class, because every particular asset class has their own cycle. Some years might be very good, some years might be very bad. Here you can take advantage of all asset classes and nullify your entire gains, I mean, entire experience of a bad or a good phase that's coming. And instead of going like this, you will just keep going like this very moderately. Right? So that is how your mentality should be towards an asset class or an idea or a category that's extremely overheated. Always target towards better opportunities. Don't ever stop. So this is the milestones to wealth behavior model. And in a boring market, right, when you see that there's not a lot of action taking place, there is basically it's at the low of the cycle when there's a lot of pessimism and there's a lot of fear. What should you do as an investor, right? Milestones to wealth exactly does this, where we help you in getting in the right set of behavior for a lump sum, for SIP, for step up. When do you do a lump sum? When do you do a step up? How much of your SIPs need to be going for a particular goal, right? If you have a retirement goal and you have a long way to go, what is the best corpus for you based on your income, based on your risk profile, based on whatever assets that you've been able to build? What is the ideal corpus for you for retiring? At the same time, making sure that okay, the corpus that you've built, how many years can you live off that corpus that you've been able to build for years on together, right? So in a boring market, uh, uh, we help you do lump sums at the right time. We help you uh, uh, improve your behavior in terms of contributing monthly and making sure that you contribute more, which means sitting with you, holding you by the hand to make sure that you're able to save more and have a proper plan in place to making sure that that contribution gets stepped up every year. So that's a very hand-on approach. And at the end of the time, when your goal is very close for you to meet, you can obviously reap the benefits out of it. So this is how Milestones to Wealth works. It's a completely behavior model driven program. It has nothing to do with if you buy this, you'll make more money. If you do this, you'll make more money. No, it's a completely behavior oriented program. We help you target towards better opportunities that can help you generate wealth stably, consistently, at the same time with lower risk. Right? It's a completely behavior oriented program. It has nothing to do with buy or sell recommendations. It's not a broker. It's a proper program where we take you, where we hold your hand and make sure that you're able to meet whatever goal you are having, be it 50 lakhs, be it 1 crore, be it for your retirement, be it for your education, be it for travel, right? Every goal can be met provided that you're able to show the right behavior, which we will help you do so. So now I will open the floor for Q&A. We have a good 20-25 minutes. So shoot in whatever questions you have in the chat box and I'll do my best to address it. Technically, it is bad to withdraw your SIP when the return is 30%, especially when you have borrowing. See, when you have a borrowing, please make sure to obviously your savings would be channeled, should be channeled more towards meeting those EMIs. And once you're done with that, then obviously you will have a lot more to contribute for your financial assets. And then at that point, we will be able to see as to what we can do best for you. but it is bad to withdraw your SIP. Like I said, it's not uh, ideal for you to stop it, but to redirect it and target it towards better opportunities. Right. So incremental money that has to go in towards other asset classes. This can continuously keep going. Whatever you want to do more should go towards other ideas, should go towards better ideas. Right. Assuming that we are in an overheated market. Okay, there is please show the second slide. Is it this one or this one? Do you want to see the market cycle or do you want to see the investor life cycle? Okay, what happens when the market crash at the last time of the goal? That only luck can save you there. But as your goal starts to approach, the ideal strategy would be to slowly start taking off and parking it towards asset classes that become less risky. Usually, what happens is a crash doesn't happen immediately, right? It's not unless it's a black swan event that uh, like a 2008 or a 2020. But in times of over optimism where things are overvalued, you get a lot of opportunities for you to redirect your uh, wealth that you made and preserve it in other asset classes, assuming that yes, and making that mentality saying I don't want to grow at very aggressive levels. I want to be very sober and I want to be very conservative in what I want to grow at. Right. So as you approach your goal, we would be able to help you in making sure that we are able to preserve the wealth that you've created. Right. Unless and until it's a black swan event. After COVID low, market is going in one direction. How to know one should invest? That's exactly why for the program, we help you in terms of how for your particular risk profile, whether a lump sum would suit you also or not. Like some investors, you might not be able to weather through and don't have the appetite for that particular opportunity, right? Lump sum might not work for some investors, SIP might work for some investors. So depending on your risk profile, right? So I'll put in the number. This is the table side. This is what you wanted to see. Right. So I'll put in the number also at the end of this. And do get in touch with us. Depending on your risk profile, we will be able to help you out the best. Right. Depending on your risk profile, what suits you the best? Can you weather through a lump sum or SIP would work for you? And when should you do a lump sum? We will be able to tell you based on your risk profile as to when you should be able to do a lump sum. So you will get continuous alerts. You will have a dedicated point of contact who you can get in touch with, who will get in touch with you whenever there are opportunities for you to keep doing a lump sum or SIP. How do we continue with SIP? Like I said, you should continue a SIP towards better opportunities. Now, for example, equity has performed extremely well in the last 2.5 years after COVID, one way, right? And a lot of investors are new to the market. In times of over optimism where things are looking very, very good, things are rosy good, you open the newspaper or you open Instagram or you open Twitter or you open YouTube, everybody is extremely positive. Things are looking extremely rosy good. What do? You target it towards better opportunities. You look at other asset classes like debt and precious metals for you to start saving money. Ultimately, you will be able to use that whenever equity as an asset class become extremely undervalued or become extremely pessimistic, and you might get a better opportunity at that point. Right now, always look towards other opportunities, right? You should always look to target incremental SIP, which means, let's say if you're doing 10,000 and you want to do 5,000 rupees more SIP, that 5,000 rupees should go towards other asset classes. So, but never stop your SIP. Always look for better opportunities. Don't stop it. Always look for something higher. In the range one market, SIPs are not going to do any rupee cost averaging because we'll be buying literally more of the same units. Yeah, that's why target towards where you'll be able to buy more units at very cheap valuations. Always look to do that. Will Nifty go the Nikkei way? I don't know if Nifty will go the Nikkei way. Nikkei did not show any growth. Japan did not have inflation. Interest rates were extremely low. Here we are having inflation. We are having earnings growth. Maybe not for a developing nation like India. This question is relevant for a developed nation, but not for a developing nation like India. iThought provides RIA services. We provide planning services. So planning, the last webinar was on financial planning and asset allocation. And we do have financial planning. We have a team that is dedicated for financial planning. So do get in touch with them. Just put in a hi and say that yes, I want to avail financial planning services, and we will be able to help you out. Right. RIA, we do have the license, but RIA as a service has been discontinued. Okay, my daughter is 24 years now. She's going to join PG, and she will get a 3-year stipend of around 50,000. So it's 50,000 per month. Okay, how much to save in SIP to start a clinic? Fantastic. This is excellent. Uh, See, how much is so what we can do is just send us high one-on-one. We will be able to discuss with you as to what is the best way for her. But in general, we will look at her expenses. We will look at how these expenses are going to grow and how much of a contribution needs to be made. Let's say if a clinic to start a clinic, it might take 15 lakhs. So how much of a contribution do we make to achieve that 15 lakhs given a very moderate expectation for growth? Right? But do text us, just send us a hi on this number, and the financial planning team will get in touch with you. Okay, I came for a short-term on-site, hence I can do more amount as SIP, but in a year or two, I may move back to India again, which may result in reduced SIP. How to handle this situation? No, just continue your SIP going on. Yeah, there might be some problems that you might arise because of your situation where you might have to contribute less, but don't forget you're still contributing. So keep your contributions going, right? After 2 years, when that situation arises, for you to see what you have to do with those contributions, that time take a call of how much you are able to contribute, and that time we will have to see as to what is the best way for you to do. Right now, keep continuing your SIP. When the time comes of it resulting in a reduction, that time we will take that call. Right now, just keep continuing. After 50 lakh, I'm assuming that according to your risk profile, we can opt for PMS. Yeah. So there is no compulsion from our side that you have to do a PMS. That is an aspirational product for everybody. Uh, but for Indian investors, mutual funds is the best way for you to start building wealth. After you reach 50 lakh, it's up to you as to what you want to do based on your risk profile. So we have a product. We have 4 products for all risk profiles. Aggressive is small cap. Moderately aggressive is flexi cap. Slightly conservative, which is lesser than moderately aggressive, but higher than conservative is multi-asset, and completely conservative is large cap. So whatever suits your risk profile, you can opt for that. Yes, can you guide to do SIP in the name of a minor son to meet his goals? Yes, definitely we will be able to guide you in terms of building wealth for your son's education corpus. Just send us a hi here with your requirement, and somebody from the team will get in touch with you very soon. Monthly SIP into MF per month in India, 18,000 crores, 19,000 odd crores right now. You go to 20. Yes, as per mutual funds, have to invest a large percentage of these funds every month into the market. The market will continuously go up. What is the error? No error in this statement. Domestic flows have been extremely strong. We are contributing a lot of it, and we've been contributing a lot towards small and mid caps or in equity, in the equity category, which is a worry. And so last year around 40,000 odd crores has gone into small caps, 20,000 odd crores has gone into mid cap, which is a worry because these are small companies, liquidity is very low. So as you keep contributing more, they will have to take a lot more risk. So naturally, that might become a problem. But other than that, yes, domestic flows have been extremely strong. And you might not see that deep of corrections that come in because we are strong, we are contributing more, our incomes are growing, and we want to save more as a population. As we start getting mature as investors, we want to save more. So naturally, don't expect deep bad cuts to take place, but you can expect some volatility to come in in the future also, maybe in a year or so. But yes, we are contributing more. So they have to invest. Not continuously go up, but they have to invest. So there's a lot of liquidity that gets immediately accepted as, let's say, if there's a small fall that comes in also. Will the US default with the debt soon? Maybe. Their debt levels are at the highest level. Their inflation is extremely high, yet their currency is slightly strong. So it's a very peculiar scenario to look at. Alternative currencies have done extremely well, that is commodities. So their debt is coming up. It is getting matured in the next 3 years. So we don't know whether they will default or not. I mean, they can come out of the situation however they please. They can rebase their currency. They can do whatever they want to because it's a reserve currency. They can print more also to get their way out. But essentially, since 2008, they've been only printing to get their way out of things. So we don't know whether they will default or not. What is the minimum or maximum number of funds one can hold in small, mid, large? It depends. There is no ratio of that sort. Wherever the opportunity is, you should only look towards that. Right? You being a conservative investor or aggressive investor doesn't mean that you can take 10 funds or so. It works against. Ultimately, you're buying the same basket in various names. That's it. Right? So it depends on your goal. It depends on your, what you want to achieve. Your risk profile can be aggressive, can be conservative, but majorly it depends on your goal that you have. Will you rotate SIPs as per sector rotation? See, there will be dedicated contribution that goes. So we've had for aggressive investors thematic and sectoral contributions, but it all is based on the risk profile. There will not be rotation. There will only be incremental. Like I said, we do not, as a saver, as somebody who wants to reach 1 crore, the mentality has to be such that no, I will only target my SIPs towards better opportunities. I will only target my incremental SIPs, which means let's say 10,000 and then I want to do 5,000 more. That 5,000 more has to get contributed towards better opportunities. There was no rotation, which is no stopping, no starting, no stopping, no stopping, nothing like that. Thank you, sir. We'll meet after PG exam. But yes, but please do message us here, and somebody from our team will definitely get in touch with you and keep sending you content. And when the time comes, definitely we can meet one-on-one also in office. Real estate also have given very good returns in the past decade. Not so much, but rental yields are very low. Prices have gone up now. Last 2 years also, we've seen a lot of price increase coming in real estate. Suggest me an asset class for the next 2 or 3 year of goals. I don't know what your goal is. I don't know what you want to achieve. I don't know what you're targeting. But to keep this dialogue open, to keep it continuously going, please do get in touch with us. Somebody from the team will be able to help you out as to what your goal also should be. How to rebalance SIP portfolios with tax efficiencies? Very good question. See, mutual funds always keep it very simple. Your long-term tax is 10%, short-term is 15%, same equity tax, right? And a multi-asset or a BAF will take advantage of debt and precious metals also and still be able to give you uh, slightly more or less equity type of return, slightly lower than equity type return, while being tax efficient, knowing very well that they're doing other asset classes, right? So you can take advantage of these particular products, but rebalancing your SIP only when you are near a goal, that's when you should do for tax efficiency. Otherwise, you should not do. Right? Or it's too weighted, you don't have any contributions to make any further, you're wiped out, you're done. Then depends on that particular scenario, what we can do. How do PMS works? I invest 50 lakhs to buy on the NAV, or purchase happens in my investing account where I share my credentials with the PMS. It's not based on the NAV, but so essentially how it works is a PMS would open an account for you, brokerage account, custodian account, bank account, so on which you transfer that particular sum of money, 50 lakhs, and they invest on behalf of you. If it's a discretionary payments, they invest in stocks or mutual funds or ETFs or wherever they deem fit, and everything will be in your name. It will reflect on your NSDL as well. So it's stocks that will come, that will be reflected in your name. It works like a mutual fund, but you don't get a NAV. You get the stock straight away, right? But for a mutual fund, you will get the NAV. So in our PMS, So for a mutual fund, if you compare mutual fund to a PMS and how is our PMS different? So for a mutual fund, you get the NAV, right? Which means every investor, let's say if they want to invest, they will get the same NAV. I start today, you start today, both of us get 30 rupees NAV, right? Or let's say even 6 months from now, let's say you start today and I start 6 months from later, I'll get that NAV, you will get this particular NAV, right? But for our PMS, it works completely different. For somebody, so everybody's portfolio is built different because their contributions are different, because their behavior in how they approach saving is completely different, right? So anybody who comes in, let's say after you, would not have the same portfolio as you, because their contributions are completely different, right? They As they contribute more, we are able to buy newer ideas, we are able to scale up on existing ideas, which ultimately benefit them, and it starts working for them as time goes by, as compounding starts taking place, right? So every portfolio is starting to build different for our PMS, whereas for a mutual fund, you get the same portfolio, you get the same NAV, right? And everything will be in your name. It'll all reflect on your NSDL. So nothing is with us. Sure, we can get back to you on your SIB. We do have your email also. You would have registered, so definitely your email will be there. But definitely somebody from the team will get in touch with you. Is a 1 crore target achievable by a mix of 5,000 in DPF, 5,000 in Nifty 50, 5,000 in Next 50, 5,000 mid cap, 15,000 in direct stock investing? It's very complicated. Your PFs must go, right? But the rest is too complicated for you because you're trying to chase returns, right? Nifty Next 50, mid cap, direct stock investing, you're trying to chase returns, and it's very, very complicated. Keep things very simple. Your PPF definitely should go, and your PPF is meant for other things. Uh, your PPF definitely needs to go, but the rest is very complicated. Milestones2Wealth only wants to make things very, very simple, right? It only has to do with, okay, this is how much I should contribute, and where you have to contribute, that we will take care, because we don't like taking much risk. We are very conservative in terms of how we want to allocate money, right? So keep things extremely simple, right? You don't need to have direct stock investing if you're doing mutual funds as a basket, because they are already doing direct stock investing, right? Do one thing, but your PPF definitely must go, and the rest needs to be very, very simple, right? So if I just see 5 and 5, 10, 10 and 15, which is 25, and 25 with a 10% step up increase, when do you reach it? So let's say if you do 25 and you're trying to step it up, you'll do it within 10 years. So I hope that answers your question. You'll be able to do it within 10 years. Growing at very moderate 12% sort of return. If you take 9 also, you just do it by another 3 years. So instead of being too picky, instead of being too choosy, keep things very, very simple. I have 10 crore to invest in one shot. How to do that? Please do get in touch with us. We won't do it in one shot, but definitely do get in touch with us. We will be able to help you out in terms of how this 10 crore needs to be deployed and where it needs to be deployed based on your particular goals, based on the goals that you have. See, again, boring stocks is meant to show you from a behavior perspective that you can take lesser risk and still be able to make good returns, right? Boring stock is not a recommendation, it's not advice. You are all choosing to see it as recommendation and advice. But internally, when we were trying to do this experiment to show that, yes, since our model is such that we are doing conservative investing by making sure that we're taking lesser risk. That doesn't mean that we are not taking any risk. We just want to take lesser risk by making sure that, yes, our investor has a stable experience, a consistent experience in terms of investing and saving in India. At the same time, give them very good returns. Give them more returns than FD, give them more returns than GDP growth. Right. So boring stock was a very good experiment to show from a behavior perspective, right? While we can be, while we be conservative, we can still make good returns, right? So we were very conservative when it came to looking at boring as an idea, and that's why you saw even in my Milestones2Wealth behavior model, we kept it as boring because we understand that these are very simple things. These are things that investors consider to be very boring. But boring is what leads you to have to build very large sums of wealth. It's nothing to do complex. Simple always works. And we wanted to show that yes, simple works. Simple will work. Simple can continuously keep on working for you, right? So don't take boring as advice. Don't take boring as so we will not be able to help you out if you do something on boring on your own. It was a very good experiment for us, and we backed it up with data because it was real time, and we were able to show that particular data out. It was a behavior model to show that yes, conservatism works, right? And that was the model that we were following. But as markets were doing extremely well and people were they were going gung-ho about taking a lot more risk, we thought that no, investors can still make good sums of wealth while they take lesser risk. So, and we were doing it, so we wanted to show that yes, you can do it. So that's why we named it as boring. Nowadays, I see more people talking 10 to 100 crore. No, not at all easy. It's not a comment. It's not easy. If things were so easy, then everybody would have 10 or 100 crores in their pocket. But it's not very easy. To build your 1 crore, you need to have the right set of mentality. You need to have the right set of behavior. This is a test match. This is a proper test match. For 5 days, the pitch keeps changing. Ball comes here, ball comes here, ball comes here. You're already wearing a helmet, you'll still get hurt. You're wearing a pad, you'll still get hurt. You have enough protection, but you will still get hurt. How do you manage that particular hurt? Right? And how do you stick at the pitch for 5 days together? Investing is right all about behavior, and treat it like a test match. Don't treat it as T20. T20 is mad on all the pitches today. You're seeing 200 plus score, but don't treat this as T20. Treat this as test match. Not even ODI. Treat this as test match. Yes, sir. MTW provides tax filing services. No, we do not provide tax filing services, but we can help you in terms of your how much capital gains or how much realized gains. With that statement can come to you. If you do on board with us, that we can help you out. If we see another opportunity, I can understand investing in lump sums helping by certain goals. Our existing saved corpus also would go down drastically. Will you guys suggest to book profit and park in debt fund or re-enter the market? What? Let the situation take place. Right now, the situation looks very bleak. We don't know a war-like scenario can happen or not happen. Even COVID, when it happened, a lot of people did not know how to deal with it. Right now, looking back, it seems that yes, had I done this in COVID, things would have been very good for me. Nothing like that happens. In reality, things happen and you don't know at that point of time what to do. But what you can do in your control is your behavior. Right? A COVID-like scenario, don't think of a black swan. Don't try to anchor to black swan events telling if a black swan happens, my behavior should be this. You can think of how black swans have happened in the past and how investors have reacted, how market has reacted. Market is collective sum of people. How are people reacting to things? And at that point, I would do this. So right now, given the fact that there is over optimism in one asset class, you should look towards saving in other asset class, as other asset classes. Re-enter, enter at that point of time, whatever the scenario is in all the other asset classes, you have to judge only based on that, and we will judge only based on that particular opportunity. Thank you, I thought team, for your continuous support for small investors. Thank you, sir. We only want to work in making sure that no matter how small or big or very large, that you are able to meet your goal and you show the right amount of intent and behavior when it comes to saving wealth, right, for your future, for whatever goals are there. And we uh, uh, definitely want to handhold you in that journey where you are able to meet your goal. At the same time, we are very happy to make sure that yes, Indian investors are now becoming a lot more mature and they're showing the right amount of behavior uh, uh, in in meeting their own goals that can come up in the future. So yes, we are very open to working with any sort of investor who comes in, small, big, large. Our entire endeavor is to improve the behavior of investors in India. Wish a lot of crore and more millionaires in USD terms grow in India. Good luck to all. Yes, India is very well poised to grow. We are in a very good scenario. So a lot of money is looking to flow in here. So let's see how things take place. But good, we have another 2 or 3 minutes for Q&A that's left. So if any of you have any question, do put in the chat box. But do get in touch with us for all your queries. Just send us a hi or just email to us. I've put on all the details here. And somebody from the team will definitely get in touch with you. I'm happy to say that M2W research team always is keen to watch the current market, and I'm like, guys, yes, we are a very large team that continuously keeps reviewing portfolios, is always in touch with you. Make sure that you're very well educated to weather through whatever conditions come to you, whether it is good or bad. So thank you so much, sir. Thank you so much. M2W only invest in large cap. Markets will be corrected and valuation at favorable zone. That time, what will you do? That time we'll see. Not now. When the time comes, we'll see the time. Right now is not the case for you to think like that. Internally, we are thinking a lot of ideas for all different scenarios. But if the scenario doesn't play, then there's no point of always trying to look at that particular thing. Yeah, there are contingencies in place. There are ideas that are definitely there in place. If you're on the program, you would have gotten a lot more calls saying that, yes, this is a sort of behavior you need to show right now. So yes, if you're on the program, you will get to know what we're trying to do. Recently also, I have done, I think, 2 webinars on debt. Debt is a good opportunity for investors to look at. And again, next month, I'm doing another webinar on debt. So do follow us on social media, and you will get all the details if you're on the program as well. So just send us a hi, get on the program. And when you're on the program, you'll start getting in the content. You'll know at that point what we are going to do and what we are trying to do for you. Small cap, I don't know. Depends on that time. Will you guys invest in your own products? I mean, we are all having contributions that are taking place. Uh, uh, so, our only product is the PMS. And when we reach that 50 lakh, like somebody commented saying, can I choose a 50 lakh product? At that point of time, if we meet it, we will take a call depending on individual goals, individual risk profile as to what to do. Great. So I don't think there are any further questions coming in, but thank you so much all for joining in on a on a holiday on a Wednesday afternoon. It was a pleasure interacting with each one of you, and thank you so much for joining. Thank you so much. Have a great day. Thank you.